What I am about to show you is proof that the global silver supply chain is collapsing in real time. Right now, silver is trading around $86 per ounce. But here is what they are not telling you on mainstream financial news. Temporary pause on new silver bullion orders. Unprecedented bullion demand is resulting in early queue closures. That is directly from the Perth Mint website, right now, today. Due to the increasing worldwide demand for silver bullion products, we have a large backlog of orders for the 2026 Kangaroo 10 silver bullion coin. As a result of this, we have decided to pause taking wholesale orders for this coin. But the Perth Mint is not alone. The Royal Canadian Mint and Perth Mint are both out of key products. SD Bullion had fewer than 2,300 units left at last count, and Costco, zero silver or gold at any Ontario location. Global mints, refiners, and dealers are running out of physical silver as demand overwhelms supply. From Canada to Vietnam, inventories have vanished, and even raw materials for minting new bars are drying up. If you own silver, you need to understand what this means. If you are trying to buy silver, you need to understand why finding physical metal is becoming nearly impossible. Something has broken, and by the end of this video, you will understand exactly what it is. Welcome to AG Profit Hub. This is where we cut through the noise and expose what is really happening in precious metals markets, while everyone else feeds you the official narrative. Subscribe right now and hit that notification bell, because this situation is evolving daily. If you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see the truth. And trust me, what I am about to reveal is something the mainstream financial media refuses to cover. Let me walk you through exactly what is happening at the Perth Mint, because this is unprecedented. These are extraordinary times for the precious metals market. Gold and silver prices continue to set new records, with gold up 65% in US dollar terms in the year to 34 in December 2025, and silver rising almost 150% USD for the year. That momentum has continued into 2026. At the Perth Mint, we have seen historically high demand for bullion and minted products since mid-2025, as many investors turn to gold and silver as safe haven assets amid ongoing global uncertainty. Now here is where it gets alarming. There has been extraordinary interest in our range of silver bullion products in particular, resulting in unprecedented logistical and production challenges in meeting the volume of orders. To avoid disappointing customers, we have limited the availability of some silver products. 4. Back orders have been turned off temporarily on certain lines, such as 1 kilogram silver cast bars. We have also made the decision to limit the size of orders on some popular lines, including 1 kilogram cast silver bars and 1 kilogram silver coins, and some products will be limited to in-store sales to avoid disappointing customers. And here is the most revealing statement from the Perth Mint. As Australia's leading precious metals refinery, we can assure you there is no shortage of silver. It just isn't in the specific forms being requested by our customers, which is putting pressure on manufacturing operations. Read that again carefully. They say there is no shortage of silver, but they cannot produce the coins and bars that customers want. The manufacturing capacity is the bottleneck. Our inspection, packing, and dispatching processes are highly manual. Every coin, bar, and numismatic product is individually inspected, and items require careful handling as they are placed into sleeves, tubes, or boxes. We are currently increasing staffing resources in our coin production, order fulfillment, and customer service areas to speed up these processes. Our production efforts are concentrated on core silver products, including the 1-ounce Kangaroo and Kookaburra coins and 1 kilogram cast bars. But here is what is critical to understand. This decision to halt silver sales was made prior to the historic $25 silver slam that has since occurred. If the Perth Mint was already at the breaking point by Thursday morning, with silver prices trading near $117, we suspect this situation is about to quickly snowball across the industry, as today's price smash has undoubtedly unleashed a tsunami of physical silver demand. The price crashed, but the shortage got worse, not better. Now let me show you what is happening at the United States Mint, because the same pattern is repeating. The United States Mint recently issued a public notice. Due to rising precious metals prices, silver numismatic products may be temporarily removed from sale while pricing adjustments are made. This is more than an operational update. It's a clear signal of growing pressure in the silver supply chain. U.S. Mint suspends all sales of silver numismatic products. No further sales until the U.S. Mint completes a review of pricing adjustments across all numismatic products. Market takeaway. The Mint has effectively paused silver sales while it reassesses how to price numismatic silver amid rising replacement and production costs. This highlights growing pressure in the physical silver supply chain and escalating cost dynamics. And here is what makes this even more alarming. In fact, the U.S. government recently took extraordinary action to secure domestic silver refining capacity. In a 2026 announcement reported by Scottsdale Mint, the Department of Defense finalized a landmark deal with U.S. industrial partners to build and operate a silver smelter that will process Latin American silver concentrates on U.S. soil. This agreement, backed by national security objectives, ensures that silver essential to high-tech defense systems, energy infrastructure, and advanced manufacturing can be sourced, refined, and deployed without relying on adversarial supply chains. This is not a small bureaucratic win. It is a fundamental repositioning of silver as a strategic material alongside rare earths and semiconductors. The Defense Department's direct involvement signals that silver is no longer being treated as a secondary commodity. The Department of Defense is building its own silver refinery. Think about what that means. The U.S. military views silver as a strategic national security asset. Now let me show you what is happening at dealers around the world, because this is not isolated. This is global. This approach has allowed us to maintain availability of both silver bars and silver coins at a time when many competitors are either completely sold out or operating with severely limited stock. We still have a relatively wide range of silver bars and silver coins available, with additional shipments already in transit. That said, replenishing silver has become increasingly challenging. Rising acquisition premiums and longer delivery lead times from suppliers have made it necessary to adjust our pricing. That is from Bullion, one of the most respected dealers in the world, and they are admitting that their competitors are sold out. Our current indicative premiums are as follows. Good delivery approximately 1,000 Oz silver bars at spot plus 5.99%. 100 Oz, 5 kilo and 15 kilo silver bars at spot plus 10% to 12%. 1 kilo silver bars from spot plus 114%. 1 Oz silver coins from spot plus 112%. Premiums of 10 to 14% just to get silver. That is not normal. That is a supply crisis. Australia, Africa, Canada, Vietnam, the UK, and the US are all showing the same signs. Empty shelves, delayed shipments, and back orders stretching out weeks. And here is the most alarming part. Even more concerning. In Vietnam, dealers report that raw materials themselves are running out. The raw materials, not just the finished coins and bars. The silver itself is disappearing from the supply chain. The supply challenge even meant that when London's silver vaults had shortages, some traders shipped silver via air freight instead of ocean shipping to meet demand. While air freight costs more, the shortage makes it worth the premium. Air freight for silver. That tells you how desperate the market has become. Now let me explain why this is happening, because the supply chain breakdown is structural, not temporary. Roughly 70–80% of the world's silver supply is produced as a byproduct of mining for copper, lead, and zinc. Dedicated silver mines are rare. As a result, production cannot quickly increase when demand rises or prices spike. New mines take time. It often requires 7 to 15 years to move from discovery to meaningful output. At the same time, many existing mines are dealing with lower quality ore and rising operating costs. 7 to 15 years. That is how long it takes to bring a new mine online. The industry cannot respond to demand quickly, even if they wanted to. For years, above-ground stockpiles helped balance the market. That buffer is now gone. From 2021 through 2025, global silver inventories declined year after year, creating cumulative shortages approaching 820 million ounces. Early projections for 2026 suggest another shortfall of 150–200 million ounces or more, 820 million ounces of cumulative shortage, and another 150–200 million this year. The silver market is heading for a sixth consecutive year of structural deficit in 2026, with the shortfall projected at 67 million ounces as industrial consumption continues to outpace mine supply. J.P. Morgan Global Research sees silver prices averaging $81 per ounce this year, more than double its 2025 average, with the physical deficit projected to reach 245 million ounces. 6 consecutive years of deficit. J.P. Morgan projects a 245 million ounce physical deficit. And here is why the mint and refiner system is breaking down. Most mints and refiners don't hold vast stockpiles of silver. Instead, they lease the metal from bullion banks, refine or mint it, and then repay the borrowed silver once new supply arrives. With lease rates now sky high, the economics of this system are breaking down. For some refiners, borrowing silver has become uneconomical or even unviable, forcing them to prioritize core products and delay less profitable lines. The entire production system is based on leasing silver at low rates. When lease rates explode, the system stops working. In years of ample supply, 1-month silver lease rates typically sit around 0.3% to 0.5%. By January 2026, this rate had exploded to around 8%. Because the market is short of silver to a clearly abnormal degree. When someone is willing to pay 8% annualized just to borrow silver so they can be sure to take delivery on time, that in itself is a signal. Physical supply and demand are severely out of balance, from 0.3% to 8%. That is not a normal market fluctuation. That is a system screaming that there is no silver. Now let me show you the factor that is making everything worse. China. China's recent elevation of silver to a strategic resource has sent shockwaves through global markets. Effective January 1, 2026, the country imposed stringent export licensing, restricting production to just 44 authorized companies. This move mirrors China's playbook with rare earths, aiming to secure supply chains for solar panels, electric vehicles, EVs, and semiconductors. The implications are profound. China accounts for over 60% of global silver production, and its export curbs are expected to reduce global availability by 10 to 15% in 2026. For countries reliant on Chinese silver, particularly the U.S., which has classified silver as a critical mineral, the result is a tightening supply chain and rising prices. Analysts project silver could test $100 per ounce as demand outstrips supply. The fundamental vulnerability facing manufacturers is extreme geographic concentration in precious metal refining. China controls an estimated 60% to 70% of global refined silver supply. 60 to 70%. China controls the majority of the world's refined silver, and they just locked the door. Under the new framework, all silver exports require government approval. Only 44 companies have been authorized to export silver during 2026-27, concentrating exports among large, well-capitalized players. Exporters must meet strict criteria, including minimum annual production of 1,080 tons and strong financial capacity, sidelining smaller refiners. From hundreds of exporters down to 44, and those 44 answer directly to Beijing. China's announced export controls combined with potential Mexican production regulatory challenges could reduce available supply by 150 million ounces annually. China's export restrictions implemented January 1, 2026, affecting 120 million ounces of annual production, 100 to 150 million ounces cut from global supply every year, while demand keeps growing. Now, let me show you the smoking gun that proves the supply chain has collapsed. The disconnect between paper and physical prices. For decades, global silver price discovery was firmly controlled by futures traders on the New York COMEX and the London Bullion Market Association, LBMA. Trading volumes in paper silver dwarfed the total stock of above-ground silver. At one point, the notional ratio reached as high as 356 to 1. In other words, the amount of silver promised on paper far exceeded the metal that could ever be delivered. This system did not collapse only because of one simple assumption. Nobody would ask for delivery all at once. In early 2026, that assumption failed. COMEX data tell the story most clearly. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery. That meant roughly 26% of COMEX's registered inventory disappeared in a single week. 26% gone in 7 days. That is not normal market behavior. That is a run on the vaults. Physical silver prices have broken away from paper spot prices due to extreme scarcity. Dealers are paying up to $55 per ounce in some markets just to source inventory, far above official trading levels. When physical silver becomes scarce and lease rates rise, authorized participants may be unwilling or unable to source metal for ETF creation or redemption. In such scenarios, ETFs can begin trading at persistent discounts or premiums to net asset value, suspend redemptions, or be forced into cash settlement. In an extreme squeeze, ETF shares may continue trading while the underlying metal effectively disappears from the market. Investors believe they own silver, but in reality, hold a paper claim with growing counterparty risk. This is how paper markets break, not through a single dramatic default, but through gradual loss of credibility as physical metal flows out of Western vaults and into regions willing to pay real premiums. Now let me tell you what this means for you, because understanding the situation is useless if you do not know how to act on it. With industrial demand accelerating, monetary pressures intensifying, and physical supply constrained, silver's repricing may still be in its early stages. Many now view prices above USD 100 per ounce in 2026 as increasingly plausible, not as speculation, but as a consequence of structural realities. If you are holding physical silver, understand what you have. You are holding one of the scarcest assets on the planet right now. The takeaway for 2026 is clear. The silver market has moved into a high-price regime characterized by chronic supply shortages. The recent correction from $120 to $80 should be viewed not as a sign of weakness, but as a stabilization of a market that had become overheated by speculative fervor. The fundamental deficit remains the dominant force, and as long as the green energy transition and AI infrastructure build-out continue, demand will remain robust. If you are looking to buy, understand the new reality. The result is a widening gap between supply and need. Without major new mine discoveries or rapid technological substitutes, physical availability tightens, dealer premiums rise, and prices face sustained upward pressure. As the physical supply remains constrained, the market remains highly sensitive to macroeconomic shifts and geopolitical trade barriers. While volatility is guaranteed, the structural underpinnings of the silver market suggest that the era of $20 or $30 silver is firmly in the rearview mirror. The era of cheap silver is over. The supply chain has collapsed, and the world is just now waking up to it. Let me leave you with this. From 2026 onward, the structural shortages that were previously papered over by drawing down above-ground inventories are evolving into an overt supply crisis that can no longer be masked. Perth Mint suspended. U.S. Mint suspended. Royal Canadian Mint out of stock. Costco sold out. SD bullion nearly empty. Vietnam running out of raw materials. Air freight being used to move silver. Lease rates at 8%. China restricting exports. 820 million ounces of cumulative deficit. 6 consecutive years of shortfall. The global silver market has entered an unprecedented phase of structural tension that extends far beyond typical commodity cycles. Unlike traditional supply shortages that resolve through price-driven production increases, silver faces unique constraints that create persistent silver supply deficits lasting years rather than months. This fundamental disconnect between available supply and accelerating demand represents one of the most compelling investment narratives in contemporary commodity markets. This is not a temporary disruption. This is a structural collapse of the silver supply chain. The global silver squeeze isn't coming. It's here. In his latest video, Mike Maloney delivers a blunt warning. Physical silver is vanishing worldwide, premiums are surging, and the disconnect between paper and physical markets is hitting a breaking point. The Perth Mint suspended again. The global silver supply chain is collapsing. And now you understand why. Drop a comment telling me if you have experienced delays or out-of-stock notices when trying to buy silver. I read every single comment. Subscribe if you have not already. Hit that notification bell, because this story is far from over. The mints are closing. The dealers are empty. The supply chain is broken, and the price correction is a buying opportunity that will not last. This is AG Profit Hub, because the real story is never on the surface. I will see you in the next one.